Not all tax deductions are created equal. Time and time again do I see business owners focusing on deductions that will end up saving them hundreds of dollars on taxes, when in reality their time would be way better spent focusing on deductions that will save you tens if not hundreds of thousands of dollars on taxes. One of the best options is the Qualified Business Income Deduction. This is a deduction that very few business owners understand, let alone understand how to plan for and plan around. And the most basic form, the Qualified Business Income Deduction, was created in 2017 with Trump's tax laws that was really aimed at helping lower taxes for pass-through entities to be more similar with C Corps. So C Corps have a 21% corporate tax rate. On most pass-through entities, they flow through to your tax return and you might be paying 32, 34, or 35, or a 37% tax rate. That's not how they wanted it to be, so they introduced the Qualified Business Income Deduction. So the Qualified Business Income Deduction is a 20% deduction against the profits of your business. So let's say that you're an LLC taxed as a sole prop or a partnership, you have $200,000 of profit. Well, it's really simple. Your Qualified Business Income Deduction is $40,000. It's 20% of that $200,000 of profits. So you'd get a $40,000 deduction. Let's say that you would be at a 20% tax rate. You'd end up saving $40,000 by 20%, which is $8,000 on your taxes. This is really impactful. So if you are any pass-through entity like that, it's pretty simple, 20% of business profits until you hit a certain AGI where the equation changes. And we'll get to that a little bit later. This is the time where a lot of people start to realize, oh wait, if I move to an S Corp and I pay myself a salary, my business profits are going to go down and my Qualified Business Income Deduction will go down. And that is true. So often people move to S Corp because all they think about is saving on self-employment taxes. So let's use that same example. So if you had $200,000 of profit and you were a partnership, well, you're going to pay self-employment taxes on the entire $200,000. So all the way up to $168,000, you're going to pay 15.3%. After that to $200,000, you're just going to pay an additional 2.9% for Medicare. So if you end up switching to an S Corp and you pay yourself $100,000 salary and now your business profits are $100,000, well then you're only going to get a $20,000 deduction versus $40,000. So instead of saving $8,000 on taxes, you're going to end up saving $4,000. So that's a big thing. The other side of it though is that you would save on self-employment taxes. So you would end up saving 15.3% to 168, and then that 2.9% above that to the 200. So at the end of the day, the S Corp might win here slightly, but the numbers aren't as good as what most people think because they fail to think about the Qualified Business Income Deduction. Again, recap, 20% of business profits is the deduction that you get until your AGI gets to about $483,000. Once your income gets to that level, then you're above the phase out and the calculation changes. So the calculation now becomes the lesser, keyword lesser, of 20% of business profits or 50% of W-2 wages. So let's go back to this example. Let's say you're a partnership, you have $1 million in profit. Well, your deduction would be the lesser of 20% of business profits, so $200,000, or 50% of W-2 wages. Let's say you have no W-2 wages, it's just you and a partner, you're the two owners, well then your Qualified Business Income Deduction is going to be $0. Let's look at another example. Same thing. Let's say you have $600,000 in profit and $400,000 in W-2 wages. Well, 20% of $600,000 is $150,000. 50% of $400,000 is $200,000 for the wages. So you'd look at the lesser and you'd say, okay, I get the $150,000 deduction versus the $200,000 of W-2 wages. That's a pretty good deduction. That's actually going to save you a lot on taxes. This is where the planning becomes really important. You want to try to optimize where this 20% of business profits and the 50% of W-2 wages get as close to equal as they can to maximize the deduction. But in all reality, that can't perfectly happen. You know, maybe your business has a lot of wages because it's capital intensive. You need a lot of help from people. And then there's other ones where you can actually fine tune this really well when you don't have it, and you can raise the owner's salaries pretty high to maximize this. Here's the caveat. Once you hit that phase out, not everybody gets this deduction. So you have to figure out if you're what's called an SSTB. It's basically a specified service and trade business. Financial advisors like me, lawyers, consultants, really anybody that has a business based on their name, image, and likeness is what's considered an SSTB. So when you cross that AGI of $483,000, if you are an SSTB, you get no deduction. So the planning becomes really easy, but as a financial advisor, if I'm below that AGI, let's say I have 200,000 of business profits, well, then I still get the 20% of the 200,000, the $40,000 deduction. So let's recap. Qualified business income deduction is one of the best tax planning moves there are for you. You need to make sure that you're trying to optimize and have your profits be as high as possible early on while still keeping a reasonable salary if you're an S Corp. Once you hit above $483,000 and you're married, it now becomes the lesser of 50% of W-2 wages or 20% of business profits, unless you're an SSTB and then you don't qualify. So the last part is really how do you plan around this? So early on, you just really need to do the analysis if you're thinking about S Corp or staying as a partnership or a sole prop to really start to figure out, like, is there actually tax savings here and does it make sense for me? When you cross that AGI, if you're a non-SSTB, you need to look at where your salaries are, where your profits are, and think, are there any ways to try to get this closer together? Oftentimes, I see business owners pay bonuses at year end or different things like that. And that can work really well if you need to raise wages to kind of get this deduction to be together. But a lot of people don't need more wages, and more wages reduces profit, which ends up reducing the qualified business income deduction. So it ends up being better to pay those through distributions. So that's it. That's everything. It's one of the best tax planning moves that you have out there. Work with your tax team and your financial planning team to optimize this for you and your business. I have some business owners who end up saving hundreds of thousands on taxes by doing this correctly. Thank you for watching. If you enjoyed this video, please leave a like and go subscribe to my channel for more personal finance content. And as always, please leave your thoughts in the comments below, and I promise to get back to every single one of them. We'll see you back next week.